Hello and welcome back to another talking point where each week we're going to be tackling specific points around business, tax, and investment. It's a beautiful week, and you're making a very wise decision today by listening to this interview because you're going to walk away today knowing a little bit more than you did before, and that is how the wealthy live. They learn all the time. So well done for that. For those viewers who are already subscribers to the Wealth Masters Club, you would have received our weekly newsletter on Friday, which highlighted the topic of capital gains tax. So what we're going to do today is talk a little bit more detail about what is capital gains tax, and there are a couple of questions from our viewers. And to answer these, we've invited our very special guest, who is Cassie Henning. He's our tax specialist and the man that knows everything about tax. So Cassie, welcome, and thanks for joining us.
Thanks, Damien. Thanks for having me.
Cassie, now the very first question is, I think for those people who might not know or have the understanding, what is capital gains tax, who pays it, and why do we pay it?
Well, capital gains tax is, in the word, it says gain. So it's when you sell an asset and you gain something. So it's just another tax to fill the treasury's coffers, if we can call it like that, or the treasury chest. So capital gains tax is when you got an asset and you sell it and you made a gain, and then you need to pay tax on it. So you can get a capital gains tax, a loss, or a profit. So you can make a capital loss as well.
Right, Cassie, now at the Wealth Masters Club, we obviously advocate for property to be held in a trust. I mean, that's the core of our business and what we believe in, because of many reasons, but also the tax saving benefits of that. So how much tax is payable over and above capital gains tax if you own property within a trust?
Well, if you sell a property in a trust, it's basically the same as selling it in your personal name. So when you sell a property, obviously there's capital gains tax, but it's not to say that you need to pay it in the trust. And that's the magic of a trust, that we can use the conduit principle to set off the capital gains in the beneficiaries' names.
So Cassie, you mentioned the conduit principle there. Would you mind just giving us a quick 2-minute overview of what that is for someone who might not be, they might not have watched one of our webinars or training before and might not understand the conduit principle, just so that they could know how that could be used in their everyday lives or with their investments or for specifically tax saving?
Yes, Damien. So the conduit principle is where the beneficiaries of the trust gets to declare the tax in their personal capacity. So a trust allows you to move the tax liability to the beneficiary's name. So you can't do it in your personal capacity and you can't do it in a company. So the thing is, the conduit principle allows the beneficiaries to declare whatever tax or profit was made in the trust in their personal capacity.
Cassie, I think a question that a lot of people would be asking if they might not be aware of these tax-saving methods, are they all legal and are they all above board? Because I think the general consensus or the understanding is, or the way we've accepted things, I guess, is that people say you have to pay tax, and whatever tax is told you have to pay, you pay that. So are these actually legal and above board?
All 100% legal. So I call it tax planning. So yes, we have to pay tax, but there's ways to minimize your tax. And that's tax planning at the end of the day, where you can plan the tax, and especially in the trust, you can plan your tax accordingly because of the conduit principle and the beneficiaries of that trust.
Fantastic. Now, Cassie, we had a couple of questions come through from our subscribers who receive our newsletter. So one of them came from Dinesh, and he said, what would the difference be if he had a property in a company registered as a PTY Ltd?
Okay, so in a company, on the profit of that asset that you sold, you made a gain. So 80% of that is taxable by 28%, the normal tax margin for a company. So in a company, you'll pay on 80% of the profit times the 28%. That's the tax you're going to pay. And unfortunately, you can't do anything about it. That's in a company, you'll need to pay that.
And then what would the benefit be of doing that property investment in a trust versus a company?
Okay, so in a trust, it's also 80% times 45%. So in a trust, is much higher the capital gains tax, but we never want to pay the capital gains tax in the trust name. So that's why we use then the conduit principle to distribute the capital gains tax out to the beneficiaries. So there's two things that you can do. You can distribute income to a beneficiary and capital gains tax to a beneficiary.
That's exactly, that already helps a lot of people understand a few things. Then the next question we had was from Mohan. He said he's got two properties in his own name. And for the purpose of a hypothetical conversation, let's say they're 360,000 Rand each. So if he moved them to a trust with a loan account of 950,000, what would that tax implication be to him in his personal name?
Okay, so because he bought the property, and this is just something I want to highlight here, he bought the property for 360,000, and that's normally your base cost on your property. But you must remember, any cost that you had to register that property is also forming part of your base cost. Say, for instance, the other thing is he might have had improvements on that property, and that's also part of the base cost. So let's in this scenario say he didn't have any cost or improvements. So 360 minus the 950,000. So that is then a gain of 590,000 Rand in his name. So he then gets a 40,000 Rand rebate from SARS, obviously. So let's say he's going to pay on capital gains tax on 40% of the 550 that's left. So that's 220,000 Rand times his tax margin. So it's very important that you know your personal tax margin. And remember, this can put you in another bracket as well. So, but it's going to be times 26%, 26, 31, 36%, 45%, depending on your personal tax margin. So yeah, it's important so that people, and this is a very important thing, is people forget to keep record of the improvements of the property, because remember, it forms part of your base costs.
I mean, I guess the general consensus is as much as we can save on tax, I think that's what people want to do, because you're putting your money into your investment, you want to get that return in many ways. So now the second part to Dinesh's question is, can these donations be done over several years from the client to the trust?
Okay, so what happened in Johan's case is moved it with a loan account. So obviously the property was paid cash, and he's basically then the bank. So the trust owes him that 950,000 Rand. And yes, that loan account can be worked off with donations, or whenever you withdraw money from that trust to himself, that will be seen as repayment of loan. So there's two ways: physical payment of money or a donation each year onto that loan account. You must just remember Section 7C still apply for interest on the loan account. So there might be an interest portion that you need to declare also in your personal capacity.
Fantastic. Now, for the viewers at home, the next question is relating specifically to our newsletter that we sent out on Friday. So for those of you who haven't read it yet, I'm going to give a link in the description below so you can have a look at that article just to get a little bit more background information on the next question. So the question comes from Anwar, and they said, in the example that we used in the newsletter, the calculation of capital gains tax for the trust, we arrived at a profit of 90,000 Rand, which is 80% or 72,000 Rand, which is the beneficiary. Now, if that beneficiary is already earning above the tax threshold, would the full 72,000 Rand would then obviously be taxable. So now, if this property investment was done in the personal name of the individual, there's an annual exemption of 40,000 Rand that would apply. So reducing the 90,000 Rand to 50,000 Rand capital gains tax. So in this scenario, would it not be better to have the property in the name of the individual, or the individual being taxed at 50,000 Rand versus 72,000 Rand worth of tax?
Okay, so this is still, again, the magic of the trust. So first thing is, you distribute the whole 90,000 Rand to the beneficiary and not just the 80%, because we need to distribute the whole profit. So on that 90,000 Rand, remember, the nature of the transaction must stay the same. So it's capital gains tax in the trust. So we're going to declare it as capital gains tax in the beneficiary's name. And you still get your 40,000 Rand rebate, annual rebate. So at the end of the day, same thing, if it's in the trust or in your personal capacity, you'll still come out at that 50,000 Rand that you will be taxed on. So yeah, his question basically is the 80%. So we don't do the 80%, we do the whole 90,000 Rand, and then yes, you get your exclusion of 40,000 Rand annually.
Great, Cassie. Now this raises a question for me in terms of, obviously we aren't doing our own accounting all the time. We've got our accountants. Does every accountant understand this principle of how to use trusts, how to use the conduit principle, or is there sort of special training that they had to go through to understand this? And what is the best way to find the right tax consultant or accountant who can help you with these sums?
Well, Damien, I must tell you honestly, some accountants does not use the conduit principle. It's either they don't know, or they don't know, or they don't want to, and they let the client pay tax in the trust name, which is terribly wrong out of my point of view. So basically, Destinata Accounting is the specialist, obviously, in trust accounting. So yes, not all tax practitioners or accountants knows about the conduit principle because they never work with it. So yes, Destinata Accounting obviously knows what they're doing with regards to conduit principle and the distribution to beneficiaries.
Fantastic. Cassie, thank you so much. I think that was a lot of information to take in a relatively short video, but we really thank you for your time. And for those at home, if you want to get all the news and information first, visit www.wealthmastersclub.com and subscribe. Like I said, every Friday we send out a newsletter with industry experts giving opinions on various things within the property market, in particular for investors or people who want to save on tax, or if you are just looking at an investment opportunity, that is the place to go. The subscription is free and the information is absolutely priceless. And what's added on to that is we also give a weekly free online training every weekend where you can learn how to invest in property using other people's time, other people's money, other people's skills, and you will learn all the tricks of the trade that the rich and the royals have been using for years and years and years and years. It's a great thing to watch. It's about 4 hours long, and I promise you it'll be worth your time. So if there are any other questions that come from this, please leave that in the comment section below. And if you're new to our channel, please like the video, subscribe to our YouTube channel so that you can get notifications of our upcoming videos. And we look forward to your comments and opinions. Thanks so much, Cassie. We'll chat to you again very soon.
Thanks for having me. Bye.
Cheers, everybody. We'll see you again next week.